Hello and welcome to the Power of Offset Mortgages. Today's a really exciting day because we're finally going to see the offset mortgage in action. So we've talked a lot about the power of it. This is going to really show you the power of the offset mortgage. What's really important as we set up the simulation is that our data input is accurate. The simulator, like anything, gives you results based on how good the data is that you input. Well, let's take a look at Mike and Susan. Susan is a software engineer and she earns $160,000 a year paid semi-monthly. Her net payroll deposits will be $5,490. We'll put this into the system twice because it's a semi-monthly pay. And then Mike is a high school teacher and he's earning $59,000 a year paid monthly. His net payroll deposit for our simulation is $4,048. And again, we'll do that just once into the system. Let's take a look at their budget. Now, they've gone through the course, they've looked at their budget and strategies for getting a rapid payoff. So they've been very mindful about producing this budget and very realistic. So they are currently spending $1,000 a week on groceries, entertainment, and dining out, $1,000 a month on car insurance, subscriptions, and other fixed recurring bills. They have a $613 a month truck payment and a $560 a month car payment. So for our simulation, we'll do a total of $6,173 shown as our expense ratio. So their dream is that they're purchasing their first home. They have a sales price of $650,000 on the new home, a 20% down payment, a $520,000 loan at 6.5% interest over a 30-year fixed rate loan. As we move into our live simulation, we will be demonstrating the power of the offset mortgage versus this traditional 30-year loan setup. We'll demonstrate the power of leveraging our savings application of 10%, 20%, and 30%. So let's move into the simulation. Right, this is our all-in-one offset mortgage simulator. This is where we'll be inputting our data for Mike and Susan, and we will go through each of these tabs so that you can see this in action. We will also give you a link to this calculator as well. We're going to set up a purchase, our primary residence, our comparison of the offset mortgage with traditional loan. We're going to input our information for $650,000 purchase, $520,000 loan, 30-year at 6.5. Now, when we input this, this will give us a calculation of our estimated principal and interest only payment for this traditional 30-year fixed rate loan. We're not going to add any extra payments at this time. This screen, we're going to input our deposits. This is where we talked about this being very important, that these deposits are your net deposits. Now we're inputting payroll. So we're putting $5,490 semi-monthly for Susan. And then we're going to add our $4,048 for Mike monthly. And now we've got these inputs. So you can see here that we've got a total of $180,336 in annual deposits. This is one of the powers of this offset loan. In the offset loan, it takes our payroll and it deposits it into our first lien position HELOC, which is what an offset mortgage is. And then it leverages those deposits to lower our interest. Additionally, with an offset loan, as we've discussed, it goes to principal first. So these deposits are offsetting that principal balance, so the accrual of interest is on a much lower amount. And then here's where we're going to put in our expenses. So as we talked about initially, we have to make sure we get our average monthly expenses accurate. So for Mike and Susan, we know that our average monthly expenses are $61.73. So this is where we're going to adjust our savings application. So for them, that's 30%. And then also we're going to increase our taxes because we know that this is higher given the current property tax valuations. So now what we're looking at is our average monthly expenses. Here we're going to $62.89. So we do have an option to put this in for a very specific number, but we don't need to do that for this illustration purposes. So now what we're going to do is we're going to hit calculate. And once we hit calculate, it's going to tell us, based on this scenario of $15,000 in average monthly deposits, with a property tax of $943.83 a month, average expenses of $62.89 a month, and a $4,808 leftover savings percentage. Now, again, they've been very mindful about this. They've thought out this budget. They want to pay the loan off as quickly as possible. This is not altering their lifestyle in any bit. It's just redirecting their savings to a more rapid payoff of the loan. So we'll hit calculate results, and we'll see based on these results that we're going to pay our loan off in 7.7 years. So that's 92 payments, saving us a total of $474,896 in interest over our traditional loan. Our traditional loan, at its regularly scheduled forecast, we would have paid $663,000 in interest alone for a total expense of $1,183,000. Now let's take a look here at our rates and assumptions. As we go through these simulations, I'm going to be showing you the 10, 20, and 30% options. So I want you to see initially that our rates and assumptions that are being used to calculate this information. So we're using a 1-month adjustable. This is the CMT Treasury 1-month adjustable. The margin is the fixed portion of the loan that stays the same over the entire term of the first position HELOC, and this can be changed. By changing this, it lowers your expenses up front, but we're going to look at the most aggressive options for indication on this loan. So this is showing us that with our margin and the current index for the Treasury index, the CMT index, our rate for our offset mortgage is 8.527. Now that's compared to our traditional fixed of 6.5%. We're going to keep our rate remaining the same throughout the entire loan. That is not realistic, but that is the most conservative approach. Now we're going to go back to our results. And again, we'll see that based on that 8.57 versus the 6.5%, that we are paying this loan down in 7.7 years. This gives us an amazing and a remarkable amount of time that we'll look at later for wealth accumulation. So let's go back to our spending, and let's make an assumption that something happens for Mike and Susan, and they can no longer allocate this full 30% for rapid pay down, and we can only look at 20%. So that gives us $3,000 left over. We're going to calculate our results, and we can see here now that we're paying this loan off in 10.5 years. Still an amazing, remarkable of time cut off of our loan simply by restructuring our loan and understanding the power of how interest is accumulated and using this strategy up front versus on the backside. Now, let's go again and let's look at our 10% savings. So this is going to give us $1,502 a month. And this is going to allow us to pay the loan off in 17 years, saving $179,000 in interest, paying our loan off in 212 payments, again, versus the traditional route where we would have made 360 payments. And not only that, we know that historically that loan's going to get refinanced. And so this is going to continue to get reset and not really allow Mike and Susan to catch up, because the first anywhere from 8 to 15 years of your loan is typically paying interest on this typical loan, as we learned in our prior course lessons. So every time they refinance this, they reset that clock and pay those fees again, versus the power of this offset mortgage. Our clock doesn't get reset. If we do need to borrow this money again, we can just pull it right back out. We don't have fees for the loan again. But the more important issue is getting it paid off rapidly so that in 7 or 8 years, if we do want to look at purchasing another home, we haven't spent that entire time paying nothing but interest. Now, let's go back to Mike and Susan and look at our 30% again. And then I want to show you this pay down summary. This is very important and very powerful. What this does is it shows us what is actually happening, the offset loan compared to the 30-year fixed. So what we're looking at on that first line is our average minimum monthly payment of $2,047. This is what's going into our offset loan versus our traditional loan of 3286 going to P&I. We're getting a much bigger leverage because of the way we're reducing our interest. We have more of our money going to reduce the principal, which we're showing here in our second one, which is 5652. We've got a much higher portion versus 1,444 going into our traditional loan. So in other words, we're reducing our principal balance annually by 13% on the offset mortgage versus only 3% on a traditional loan. And this next line is really the most powerful one. This shows us the cost of chasing low interest rates and that being your sole focus. If you're going after that low monthly payment and low interest rate on a traditional loan, interest as a percent of principal is 127% versus only 30%, 36% on our offset loan. So what that means is our traditional loan interest rate would have to be 2.174% before it would reach the same benefit as this offset mortgage. Conversely, our offset mortgage loan would have to be 15% on average in order to have the same accumulation of expense as the 6.5%. This is a very powerful that really shows you the nitty gritty of what we're looking at and these advantages that we have with the offset mortgage. All right, I'm really happy that we got to look at this setup today. Again, you'll get this calculator so that you can play around with these numbers yourself. I don't advise you doing that without having your initial consultation with me first, but this will be made available to you. All right, see you in the wealth accumulation slides.